Hello everyone and welcome to another technical analysis webinar with Trevor Neil. Thank you for joining us. As always, we'll aim to get through everything in approximately 30 minutes. So if you have any questions for Trevor, you can ask them in the questions tab of your GoToWebinar control panel and I'll pass those over to him. We remind you that this webinar will be posted to our YouTube channel in a few hours or so time. So if you'd like to watch it again, you can do so there. And we'd love it if you'd also subscribe to our channel and click on the bell to get notified. The webinar handouts can be downloaded from the handouts tab of the GoToWebinar control panel. You should be able to see those. If you're having any problems locating or downloading them, please just let me know and I'll send you a link. The first is a guide to the different technical terms and indicators that Trevor uses during the webinar. And the second is a CFD guide, which just details all the different specifications of the products that we offer at FX Choice. If you're watching this on YouTube, these handouts will be available in the description box below the video. Please just click show more and you'll be able to see them. For those of you who don't know Trevor, he has over 40 years experience as a technical analyst and trader and was former global head of technical analysis at Bloomberg. So Trevor, over to you.
Okay, thank you very much, Dan. Welcome everybody. Well, you can see what I'm about to say here, can't you? High, higher high, lower high. This is the weekly euro, and so the dollar is looking very precarious. But let's start as usual by looking at the relative rotation graph of the G10 currencies. So let's move that over to bring the Swiss franc in. For those of you that are seeing this for the first time, in the middle here, in the crosshair, is the US dollar. Then you've got all the G10 currencies moving against the dollar. And so the things which are furthest to the right, furthest to the right is the Swiss franc. The Swiss franc is the strongest currency versus the dollar. The currency which is most to the left is the weakest versus the dollar. The thing which are highest have got positive relative momentum. So that's the Norwegian crown, although it's not outperforming, it's got best relative momentum. And things which would be below that would have negative relative momentum. This quadrant, there's nothing in it, which is called the lagging quadrant, would mean underperforming the dollar with poor upside momentum. We haven't got any of that. And we've got these samples. This is Friday, Thursday, Wednesday, Tuesday, Monday. So we can see the direction of travel of them, and we can see that the Swiss franc is moving in an easterly direction. It's strengthening further. The pound is strengthening quite strongly further as well, and all of them are actually strengthening, and that's because the dollar itself is stabilizing a little bit, but they're stabilizing at very important technical levels. So just in your mind, if you can think about it, we've got the Swiss franc furthest over here, we've got the pound here, the yen here, euro and the New Zealand dollar and the Swedish crown close to the vertical line here, but the biggest outperformance is coming over here. Underperformance, the Australian dollar and the Norwegian crown. So if you were pairing off things, long short, these would be good combinations. Rather than going dollar Australian dollar, you could do Swiss franc Australian dollar, for example. So this is the weekly chart. Each bar is a week of the euro dollar. High, 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 lower high. I've drawn in a neckline. This is the low between the left shoulder and the head and the right shoulder, the low between the two, and that's right. And it's being tackled right now. We did get notified that this might be a potential topping pattern by these bearish divergences in the RSI and the MACD, but that's of course a long time ago, back in March time. It's a big and very important threatening level. I said this 3 weeks ago, then we bounced, now we've flopped back last week, and as the dollar strengthened again, and now, well, it's just edged through. I won't call that a break, but it's looking extremely threatening. By this time next week, we will know whether it's held or it's failed. So here it is, this is the right shoulder, this is the pullback, the neckline would be here, and this is the activity going on. So we're trading right on the line. I'm not going to say it's broken yet, but it's a very dark and threatening moment. The MACD is close to crossing, the RSI is low, and we have technically broken those there. Now the implications of this are dire. for the market if this follows through. If we break the neckline, if we look at the weekly chart, let's look at what we'd be facing on the downside. We moved up here in the summer last year, a year ago, very, very swiftly. This means that there will be very little support to the market if it starts to tumble. The support to clear is the 116 level, but after that we come down and we really don't pick up support, strong support, until 111, right down there. Classically measuring from the head to the neckline there, that's 6.5 big figures. So the implication of the break of the next line would be 6.5 big figures down, which would take us right down to 111 here. So, you know, I have to say it, it sounds outrageous to say it, but there's a big threat here of a big burst up against the biggest currency against the US dollar, and the threat is right now. All right, so on the pound, as opposed to the euro where we were looking at head and shoulders top, here's the weekly chart on the pound, and here we're looking at potential double top, a different type of reversal pattern. High, same high, here's the pullback point, but we're above it here. So this is a bit less threatening actually than the euro itself. So it's holding, so far holding the level of 136.80, and that's an important level, and we're holding above it, but it's not looking strong here. So maybe this is about to form its right shoulder. However, the height of this is much smaller, and we've got solid resistance much closer here. So this is a little bit less threatening, even if it does break down. I would say the breakdown point, there's 2 points to note, are the 136.80 and the low, the spike low of this candle here at 135.70. So here is that spike low in it. And we talked about this before, as we came back to challenge the breakdown point, we saw bullish divergence in the RSI and the MACD here, making us think that it would hold, and it has held so far, but it's now turning down again, still continuing the pattern of declining highs and declining lows. And so it's pretty threatening, although not as threatening, and really very threatening pattern that we've got on the euro. So watch the support at 139, resistance at 140 and 149 at 141. Rising lows are still intact, but 136 must hold. Otherwise, we're in big trouble here too. Not as big trouble as we will be on the euro. All right, then moving to the next currency. Remember over on the Norwegian crown on the left-hand side there. So where are the opportunities there? This is the underperforming one. But here, this chart, you know, this is the dollar going up. That's the underperformance of the Norwegian crown. We've got a rising lows pattern here, rising highs pattern here. This does look like it's going to continue to weaken. And so this is not our best opportunity. I think it is weak of the week, but I think as far as the chart is concerned, I would head for the Australian dollar to try and capitalize on this best. And so here we've got this one. Now this one here is not rising very strongly at all. It's in a channel. The channel is threatening to break down, so that's a little bit of a weak strength on the Australian dollar. But the chart pattern here is at a very strong dollar support area, and this, I think, that we'll find it difficult, the dollar to keep going down and the Norwegian crown to keep going up. So this one could be your best bet for a foil against the dollar strength if it starts to develop. So this would be the best opportunity, I think, of all the opportunities you have, but you'd definitely be looking on the left-hand side of the RRG, being the weakest ones, and this one has got most capacity in the chart to give you a good foil against the strength of the dollar. But I'm really worried about the euro chart. You don't often see such clear patterns like that. Of course, it may hold. It hasn't held yet, but let me reiterate, the very important moment that we're at. So here's GBP, and rising here means GDP outperforming the Japanese yen, which you would expect given the RRG chart, and we're seeing that sort of bit of it here now. This is a weekly chart. So we've got a very clear pattern of higher lows in place here. We had this spike down here below 149, which was big surge on the downside, but it's held and it's rallied. I wouldn't say that the pattern of rising lows has been broken. So we've got a higher high, so far not a higher high. So I hate to say things like potential head and shoulders when there's no right shoulder at all. It's not a potential head and shoulder at all. It's still actually going up. It's come down here, corrected a overbought condition, if you like, and it started to go up again here now. So on the daily chart, here's the going up again now. Here's the spike low here. We are breaking this trend line here. Oh, we're touching the trend line here. Well, accurately as I can. Normally I will change that to a red line later. We're approaching it. So there's resistance. We're approaching resistance in the chart. This rally, this bounce of pound versus the yen is approaching resistance. We'll have to see how it behaves there. But what do the indicators indicate there? The RSI is steady. The MACD is definitely steady. So we're looking good as we approach the resistance. So to put it into more coherent words, the trend is up in the pound, unaltered. It's done well. It is on an up leg, again, a shorter term up leg or intermediate term up leg. We're below the highs, which is of course resistance, but this current downtrend here is being tackled. So the uptrend may well be about to resume, and we get another push upwards towards the resistance at the high of 156 up here. So it does look as though the reaction is wants to end and start to go up again. But watch, of course, the behavior at the downtrend line itself. Okay, we'll go to the cryptos now. Now here we got with the Ethereum furthest to the right, all of them to the right of 100. That means all of them outperforming the dollar now. Even though the dollar is stabilizing, now the cryptocurrencies are outperforming the dollar. The charts look a lot better. In this order, Ethereum, Bitcoin to Litecoin. Ethereum looking pretty good, Bitcoin looking okay, Litecoin still looking horrible, really, in my opinion, as a chart. So let's go through those one by one. So Bitcoin firstly. Let's go Ethereum firstly, because Ethereum was furthest to the right, the one that we liked most. And why do we like it most? It has, on the weekly chart, the pullback was the least of them all. So let's say the damage done by the savage sell-off early in the year was least here. It stabilized at 61.8 and it's rallied. The thing is, it's cleared this area trading here, the congestion is now below, so that is support. The resistance is relatively light above. The MACD is about to cross to turn bullish after having been bearish since we started the sell-off, and the RSI is clearly bullish in the weekly chart. Here's that consolidation here. We had it as a dangerous descending triangle where we 4 times we challenged this low of 1,800, but it did hold, broke the downtrend line of the descending triangle and has powered ahead. And now it's put all of the work in the descending triangle below it. This has got big support. It's looking like a really good, quite good looking chart. The trend is at 39 here. That's a high reading in the ADX. The trend is strong. The trend direction is up, and the RSI is although it's high, it's bubbling around at the top zone. So this is a good chart here, looking like it can go higher, and with all the support below, it's well supported. Going to Bitcoin, it's a sort of similar picture in the sense that we had the descending triangle here, and it held the triangle, it broke away, and it's above the support. The problem is the resistance is bigger and so much closer. And this to me makes of the two, this one the least attractive, and it also hasn't quite got the energy that we've got in the Ethereum right now in the short term. The MACD is bullish, and the RSI is also bullish here. As well, but the MACD is sort of close to being bullish. Here's the daily chart. We've just gone above the consolidation, the triangle, and the whole consolidation. We had a breakout, pullback, a retest, and rally. It's not quite as strong. It's pretty good, but of the two, if you had limited amount of capital, choosing one over the other, I'd go for Ethereum over Bitcoin. And Litecoin is, well, you know, it hasn't broken through the resistance. Here we came back more than everything else. Here we would crash through 61.8. That's a, you know, absolute obliteration of the bull market. And it's finding it a struggle. Look at the MACD, still decidedly negative here. And so this chart, with all this resistance and still trying to plow its way through the resistance, is really, really struggling. And I don't like the look of this one at all. If any weakness comes back into the cryptocurrencies, expect the Litecoin to lead us on the way down. Now, we've had some big moves on gold, and this I'm still trying to get to the bottom of it happening just around, you know, midnight at the weekend. Is this a liquidity issue or not? But it happened in silver and in gold, and in an odd sort of way, you could also say in crude oil too, which is often they're put together by hedge funds as the same sort of similar sort of asset, or having the holding for the same reason. But we had this spike. If I go to the hourly chart, you can see that this the spike was formed, but now the spike has cleared, I believe. And so maybe it's a data correction. So I'll have to see. It's still on the daily chart. Did it really go down to this level here? If it did, what it did do was it came back to retest the 1680 important lows, punch into this area of support here from this time last year, which was the major support level, and has held it and was rejected by it. But let's leave the spike open for a moment, and we've got lower highs in here. It's bearish from that perspective. It's, you know, it's really looking quite ugly, the chart here, and less attractive. I've written some notes about this market, and really, you know, as an asset class, as a defense against inflation, which does seem to be raising its ugly head, as an alternative to the stock market, it's just not measuring up at all. It's really hard to get excited about gold. You know, it does go up, of course it does go up, but you know, always you've got better around, principally the US stock market, and it's just not doing well at all. Silver's got that spike as well here, holding at support level. This is why I suspect that it isn't a bad data point, is because it occurred in them both. It would be hard to have that a bad data point in both. Holding at support, 38.2% retracement could end up being constructive, but we've got an awful lot of resistance above us here from 23 right up to 28, 29, and 30 area in here. It's a quagmire of resistance. It's going to be hard to go up. If you're interested, the gold-silver ratio is improving, so gold better than silver, which we picked up on before. But really, I keep looking at this, and this is gold versus the S&P. Gold divided by the S&P. And I've shown you this chart. I've actually brought in more data to show you the importance of this now. So we broke down here. We had, gold had a really strong run. Let's be honest about it here. In the initial phase of the panic, it really benefited from that, taking on its traditional role of it dealing with uncertainty. But since then it's had a near consistent underperformance in relative terms. It's really hard to get excited about gold in the absence of any new crisis, Middle East crisis or bear market in the stock market. These are likely triggers for it. The only thing that you could say about it is it's cheap. It's relatively cheap. It's historically cheap. It's almost back to 1, the ratio, which is where we were back in 2003 to 2004. So, cheap things are cheap not because they're bullish. I remember an old man told me that on the floor years ago. Don't buy things ever because they're cheap, because the reason they're cheap is because people don't want them. If people wanted them, they wouldn't be cheap. So that's his lesson there. Moving to crude oil too has actually done something pretty important. I think it's told us what it's decided to do about the tackling of the 2019 highs, which it was doing. It's really consolidated for weeks and weeks. We've been thinking about it. It's flip-flopped up and down, formed a consolidation up here, consolidation down here, flopped twice in between it. But to me now, it's really decided it doesn't want to go up. And it's going to stagnate and possibly move lower. So things have turned quite ugly in crude oil. The weekly MACD has been negative for a few weeks. We noticed that. We noticed the bearish divergence. We noticed all the warning signs that were there of a significant top. And now the top seems to be coming into reality. We've got resistance. It's important that this 68 level holds. There is a lot of support here, but it's punching hard into it. And it does seem to have more determination on the downside here. And the trend is picking up here on the downside. So crude oil is looking also quite ugly here. And of course, strong dollar will be a negative for crude oil if it develops. Moving to the stock indices. Now here we've still got a very bullish picture, and technicians, colleagues of mine, technicians have been, more bearish than they should be during this rampant run up in the market, time after time calling tops, and every slight sign of weakness saying there's another top. But two significant technicals which I think have, I really thought were negative about the US stock market was the equal weighted index as opposed to the capital weighted index of the S&P. So the 500 stocks of the S&P, but not weighted by their size, which really heavily dominate, weighs this index towards only a few stocks. Really a handful of stocks make this index because they're so big in the index. Even though there's 500 shares in the index, 10 stocks account for, I won't say the percentage, but it's something like 85 or 90% of the index is only 10 of 500 stocks, something like that. So basically what they do determines what this does. So it's the way the Dow is not a representative index, this has really become not a representative index either. And many technical analysts have been looking at the equal weighted one, taking all the 500 stocks and giving equal weight. And that has been consolidating for about 2 years. On that basis, the stock market hasn't been going up. If you weren't in those few stocks, everything else has been flat. But that has just broken up, really decidedly broken up. So it is, it's broadly based through the 500 stocks now. That's a very bullish thing. The other thing that was very cautionary was the breadth of the stocks. So weighting the rising stocks by falling stocks are times the number of rising stocks times their volume, and that has also been negative. And so the breadth, another way of measuring the breadth of the market, has been very negative, but that has broken up as well. That has also turned bullish in that the move is broadly based. That's another way of saying that same thing. So the you can't say anymore that it's only a few stocks which are pushing the stock market up. Actually, it's the stock market is pushing the stock market up. The only thing which is still bearish is the number of analysts, professional analysts who are bullish. Now they are really bad, and they crowd at extremes of bullishness right at tops of market. So at the current reading, these are bank analysts and sell side analysts. The number of analysts who say buy or overweight of the recommendations are at 60%. Now, bear in mind it's their job to be bullish, you know, because they're basically on close to the sell side, is at 60%, and that's as high as it was in 2002. I mean, they've never been more bullish. Now, we know how good analysts are, fundamental analysts are, and they tend to get most bearish at the bottom, most bullish at the top. Well, they are most bullish. So that is in my view, a negative message, but the breadth has definitely improved a lot. We've got some change around in the most attractive indices, but let's start with the US 500. So here's the weekly chart. Look at that, isn't it a magnificent thing? The RSI is bumbling around the top because it's strong. The MACD is looking very good there. We've got support, you know, around. It's not as dangerous as it looks. If it were to pull back, it would meet support quite quickly and quite solid support. And you know, it's strong and making new highs. Previously, we were actually saying always that the tech index was the strong index, and that was the one that we should be in, and that's not any so much different as it was before. And so being the S&P or the Tech 100 is not such it isn't so important to be in the Tech 100 as it was. They're both looking good as each other. So that's a sort of change where you had the Tech 100 looking so much better. Moving to the to the DE30, this one looks as though it's got most potential because we are if we look at the weekly chart here, we're just hovering just below its high, which has dominated for a couple of months now. And this looks ready to make a break, and that could release a lot of energy. And so in a relative terms, you know, better to be in the DE30 or the S&P. This one has got a little bit of tension, like a crushed spring, and this could be ready to burst higher and outperform the US 500 in the short term. Looking at the FTSE, the UK 100, it's lower. You know, it's got the same resistance and it's near the top of it, not as threatening, imminently threatening like the DE30. But what worries me about this one is, unlike the DE30, which will be going into blue sky, this has got a solid piece of resistance here, multi-year, 4-year churning activity from 7,200 up to 7,800 there. And that is very difficult. It's going to be very difficult for this market to make progress and not be the worst performer of the group. So, well, you have been told, as far as the ADX readings are concerned, the ADX here is 23, but on the daily chart, but that's a downtrend. You know, it's not a positive message here. Of the others, the US 500 has got an ADX of 12, that's quite a low reading. The Tech 100 has got 16, that's higher, but Germany is the highest with 30, and that is my clear favorite. I like Germany, I don't like the UK, as far as stock indices are concerned.
I'm glad you added that last part, Trevor.
Yeah. Nothing to do with football.
No, of course not.
Okay, thanks, Dan. I hope that has turned out all right.
Well, yes, thank you, Trevor. Yeah, some people did confirm that they could hear, so it seems to be a bug with GoToWebinar, but thank you for doing the webinar. We'll be able to post it to our YouTube, and people will be able to watch it there. So I think we can wrap up, Trevor.
First, if you can.
Yeah, okay. Well, please join us again the same time, same place next week. And don't forget that we're posting this webinar to our YouTube channel, as we've already said, in a few hours' time. So if you came later and you want to watch from the whole beginning, you can do so there. And don't forget to subscribe to our channel and click on the bell to get notified. So anything else, Trevor? Any last comments?
No, I mean, it's really interesting times. I did speak last week about this being a seasonally weak period in the stock market, and clearly that's not the case at the moment. But don't forget, we're at the beginning of it, and it lasts till October, and so watch out for that. But at the moment, we've got clear messages there, which I've made clear. Gold. I mean, I just can't get excited on the upside about gold at all, not with the stock market as an alternative. And watch the dollar. You know, could be really big, what's happening, either holding or breaking. It's got to do one or the other, and we'll know very soon. Thanks very much. May the trend be with you all. Thanks, Dan.
Speak to you soon. Bye-bye.
Right. Bye-bye.